Sorry.
Okay.
Go ahead.
Will people see me, or
Yeah, they'll see you.
they see the screen and me?
Yeah, they see the screen and you. Now I'll introduce now in a minute, and then
Okay.
I'll give you this stage. Now I wanna make a little chapeau here, so that people,
Okay.
you know, we don't. And I think I'll give out. Let's see how many people are already online here, so we can get started. Yeah, we already have 105 people, so
Okay, good.
you clearly are in high demand, John, and I'm not surprised.
We'll see.
Let me start so that we have time for a good Q&A. Welcome to all to this IEO webinar. My name is Nicoletta Batini. I'm a lead evaluator of the IEO. And today's webinar is going to be about monetary policy and inflation. We have the pleasure to have with us Professor John Taylor. I'll come to proper introductions in a moment. But I would like to speak for a couple of minutes to make an introduction here about this topic and why, as IEO, we're going back to this topic, which of course is on everybody's mind these days, together with other issues. While we already had someone from Team Transitory back in 21 talk to us about inflation. We think inflation is not gone away, and of course it's very important to keep talking about this and see how we can fix this problem. Let me go through some analysis. We know that inflation's been at 40 years peaks in the US, UK, Europe, but more recently, inflation figures like in January seem to ignite hopes that the worst is over and families and small businesses may actually get some relief pretty soon. And many, including policymakers, academics on both sides of the Atlantic, have been rushing to embrace the scenario of orderly disinflation as a possibility for 2023. In fact, Federal Reserve Chair Jay Powell mentioned disinflation 11 times in the press conference that followed the February 1st policy announcement, pointing markets to the minutes of the Fed for details on a possible pivot in monetary policy. And just yesterday, live from Kiev, Treasury Secretary Janet Yellen said that she believes U.S. inflation, yes, remains too high, but that a soft landing is on the radar, and her words actually were so far so good. On the other hand, recent U.S. economic data releases inserting more forcefully the notion of sticky inflation into the economic discussion, and data seem to be not contradictory, but of course we have strong data on jobs and the general state of the economy. And these are coincident indicators, while other leading indicators like inventories and order books, don't look as good, including consumer saving. So some other people have argued that, in fact, inflation's here maybe to stay, but there's a risk actually inflation's staying this high, might just stay high for quite a while longer. They see a shift from deficient aggregate demand during the pandemic to one of deficient aggregate supply, with the driving forces being more structural inflation, including green transition in energy and elsewhere, changing globalization, and a multi-year quest to enhance supply chain resilience. So to cut a long story short, we've invited Professor John Taylor, who's the man, as everybody knows, behind the world's most famous monetary policy rule, aka the Taylor Rule. John is the Mary and Robert Raymond Professor of Economics at Stanford University and the George Schultz Senior Fellow in Economics at Stanford University Hoover Institution. following, of course, many positions, including Columbia University, Woodrow Wilson School, and Princeton University. In the early 2000s, John was in DC serving as U.S. Undersecretary of the Treasury for International Affairs. So a ton of monetary policy expertise. I just want to remind us, John and I first met in Florida in 1998 in Isla Morada at an MBR conference that he organized on monetary policy rules that then led to publication of the famous book, Monetary Policy Rules. And I was going there from London with Andy Haldane to present our paper on inflation forecast-based rules. And I remember John had gathered a fantastic crowd. I mean, it was literally the creme de la creme of monetary policy theory and practice. But the star of the conference was his rule. And we were all trying to, get our models to work around his rule and learn more about the great contribution that he made by, estimating and norming a simple but very functional rule. And years later, I managed to convince John to present a paper again on his rule in Abuja, Nigeria, because the whole emerging market world fell in love with his rule as well. Of course, John's contribution go well beyond the Taylor rule, from staggered contracts to many other contribution rational expectation models. But the focus of this webinar is his latest book with Michael Bordo and John Cochrane, and that will actually be published, I think, tomorrow, right? March 1st, which is called How Monetary Policy Got Behind the Curve and How to Get Back. And I'm just, I spoke too much. I really want to give the mic to John so he can tell us more about his presentation at Hoover, his work on and thinking about current monetary policy in the United States and elsewhere. And then we'll have a floor open for discussion. So stay with us, and the floor is yours. Presentation right on the screen. I'm going to mute myself. Go on, John.
Thank you very much, Nicoletta. It's a privilege to be here at the Independent Valuation Office of the IMF. I really appreciate the time and the opportunity, and for the people that pay attention to this very, very important topic. So I hope everybody can hear me just fine. So this is basically just my opening slide, and you're right, this is in some sense based on some work that we've been doing recently. If I can get this to move.
The arrows, yeah, there you go.
Yeah. Okay, this is in some sense the book that you just referred to, Nicoletta. It's almost the same title as my talk today. This is officially coming out tomorrow. It's a conference which we had a year ago. I think it's important to think about that. And the arrow points to alarm. This is before inflation really started to pick up in the U.S. It's edited jointly with Mike Bordo and John Cochrane, as you say. And I think it's a good place to begin because it was a year ago we started talking about this, or longer than that, of course. This is a book that came out. But just look at the people who participated. So I did a little table of contents. So started off with Condi Rice, who's the director of Hoover and also a former Secretary of State and National Security Advisor. And she put this in the context of foreign policy, which is really, in some sense, where it's about. I'll come back to that. And we had a session with Clarida Summers and myself, which was just reviewing what policy rules say. And I'm going to talk about that at the beginning of my talk. But it was not just monetary policy. There was concern about fiscal policy. So we had a session on fiscal policy, was led off by John Cochrane, Tyler Goodspeed, and Beth Hammock, and joined in that as well. So, there's still a lot of talk about fiscal policy as well as monetary policy. And then we had the reason for the slow exit, if you like, the late exit, which is Bordo and Levy. Jennifer Burns and Kevin Warsh commented on that. We had issues about, do we have to worry about inflation getting worse? Well, several people thought we did. So that was one reason which we argued the Fed should start to move. It hadn't started to move at this point. Paul and Sargent weighed in with some history, is very important, with discussants of Ellen McGrattan and John Lipsky. And then the last two sessions were really on where we should go. And we had two members of the FOMC, a former member of the FOMC, Bullard, Quarles, and Waller, which really was reaching back to this idea, just, the Fed seems to be off the strategy. They didn't say it quite that explicitly, but that was the hint. And we ended with a nice talk by Monica Piazzesi, who is saying to this, let's be careful. We could be 40 or 50 years repeating the stories that had. So in some sense, this is a warning. That's the cover of the book, emphasize alarm. And so what we were trying to do is point that out. Now, I'd say one thing, this book is a series. And I just want to mention, this is the first item in the series. This is 2009. And so it's not like it's a new phenomenon. We need to be watching. It's a participatory thing. Things like rules are a way that people can participate. And so the first two members of this have passed away, and other people have participated. But this is an indication, this is an ongoing thing. We hope to have another conference coming up in May, which will be more about how to get back. But let's keep at this work, as the IMF is doing, as the Independent Evaluation Office is doing. This is a never-ending thing, and let's just hope we get out of this one easily. Now, let me begin by, if you like, I will call this the basic story of how we got here. And it wasn't too long ago that when the monetary policy rules were proceeding, and then the pandemic hit. So I just have some quotes from Jay Powell. We forget this. I find these rule prescriptions helpful. That's what he said back then. Mario Draghi, who was then president of the European Central Bank, we would all clearly benefit from improving communication over our reaction functions, another word for rule. Raghuvejan, who was then governor of the Reserve Bank of India, said what we need are monetary rules. Now that's where they were, but then the pandemic hit. And I think it's important to recognize that there was quite a bit of interest in this rules-based strategy before the pandemic, but the pandemic hit and rules were out. Rules were out in the sense they were not in the reports. They were in the reports before. I'll come back to that. But it didn't take too long. February 21, rules were back in, the so-called monetary policy report. I'll show you a picture of that. But rules were out again in February 22. At this point, there was lots of complaining from members of Congress. And so Jay Powell said on March 3rd that rules would be back. And indeed, on June 17th, the monetary policy report again had monetary policy rules back in. I'll show you that in a minute. This is the official Fed's publication. But despite they were in, there was really small changes we're seeing in actual monetary policy. So a gap still exists. I think it still exists. We'll talk about that between the rules-based policy and the actual actions. Now, one thing I want to touch on before I finish is it's not just the Fed. This is a global phenomenon, and it may be worse in other countries, but there's a similarity. Not in every country, but it's a similarity. And so I think the idea is that we still need to take action. That's the next to last point. We're not quite there yet. I know there's some debate about that, even though the Fed has moved. And there's other things going on. A lot of discussion about Ukraine and Russia and bumped up commodity prices, but it's not the basic story. What I'm talking about began before that. So this is the basic story. Now let me just give you some charts to think about. This is a chart of the total asset purchases, mortgage-backed securities, and treasuries of the Fed. And you see it increase. This is a very strong easing back in 2020 at the time of the pandemic. And it continued, but it stopped fairly recently, a year ago or so. It's now come down. And there's big questions about should they undo this? I don't think it's necessary to undo it. I think it was an indication of too much ease at the time. But the real issue is the interest rate, which we'll come back to that. But people do talk about these purchases of asset backs and treasuries. The other thing to look at is just regular old M2, which is of course a favorite of monetary economists like me. You see that increased a lot at the time of the pandemic. It's continued to increase until about a little over a year ago, and it's flattened out. And so some people are arguing it's too much flattened. I mean, there's always this debate about how to measure monetary policy. So, but this is important to put in the context of our current situation. I look at these numbers myself a lot. Now, let me just say that in 2021, this was the Fed's monetary policy report. which they issue twice a year. And they have this, I'll mention again, this type of tables back in. They took it out, they put it in, they took it out, now it's back in again. But the first one's a so-called Taylor rule, which I'll just talk about that in a minute. It says the interest rate, capital R, should equal some estimate of the long run rate plus the inflation rate times plus a half times the inflation rate minus the long run level plus the unemployment rate. And I generally think the unemployment rate could be replaced by the GDP gap, but they're closely related. It doesn't make too much difference. So that's the so-called Taylor rule, and we'll talk about that in a minute. They also had a balanced approach rule. You can see that's a little more emphasis on the unemployment rate. There's a shortfalls rule, which really doesn't adjust more if the unemployment rate gets below the natural rate. There's an adjusted Taylor rule with the lower bound, and then the first difference rule. So they decided to mix it up. I think it's important to recognize that this was in the report, then it was taken out, then it was put back in. So this is where we are now. It looks the same. It is the same. And so what I think is important is the first one there is the so-called Taylor rule. That's what they continue to talk about. It's no different, but that's where we are now, and we're still at that point in time. And so I mention that because this is still on their mind. And then the question is whether they're going to get back to this. I think they have gotten back in the direction, but not all the way. That's really what the theme will be of my discussion. Now, what's interesting to say, just early in 2022, I just got some quotes from Wall Street Journal, Market Watch, CNBC, Kelly Evans, etc. And these are all statements about the Fed being behind. And they didn't really move very much in early 2022. But this is you can look at these, they're all live articles. It's just an example of what was out there in March of 2022. And you see the picture down below. But this is to say there was a lot of talk at the time, and we don't know exactly why the Fed, I think, moved a little more slowly than they were expected to based on the policy rules. And they're still a little bit off, but don't think that this was just to happen without anybody complaining. So you can take a look at this later, and you can see how much. I like this. The Taylor rule shows the Fed hasn't messed up this much in decades. That's a pretty strong headline, but the others tell the same kind of story. So let me just mention that the Fed has tried to indicate where it's going. This is the so-called dot plot. And I put in the stars indicate the average dots during that time. This is back in December. You can see my screen is blurred a little bit by this. Let me move this away. Move this away. Yes, you can see December 15th, 2021. And you said they were just starting to move. And then, oops.
We can see it all right.
Okay, then I just want to move it. This is later. This is interesting to see. This is the green dots are whereas in September 21. Then the orange dots, December 21. And of course, they had the best guess, the dot plots were really going to be close to 25 basis points going out from April 21. And even way back then, in April 21, the so-called Taylor rule, which is, even if you assume the equilibrium interest rate is 1%, use CBO and the deflation, it was quite a bit above those numbers. Now they started to rise, to be sure, and that was moving in the right direction, but still look at 2022, 2023, still below, and they're still, we'll argue about whether they're below or not. This has all changed, but this is an indication that there was some changes that needed to be made, I think, at the time. Yes, this is where we are now. So this is the federal funds rate. And you can see it was 25 basis points there well into 22. And then it started to rise. And there's been a lot of talk about the 75 basis points moves. You can see that 75 basis points, and then it's a 50 basis point. And you can see it's a little above 4.5%, about 4.5%. And so there's a lot of talk about this being a big move. It is a big move, but of course it was delayed. And I would argue personally, based on rules or strategies, it should have occurred earlier. And we don't know if the economy would have performed earlier. We don't know if other central banks would have adjusted more rapidly. I would argue they would have, but this is in a sense it's the move. There's a lot of talk. Hey, they're close to 4.5%. What do you want? And the question is this enough? And I'm going to argue that it's not quite enough just yet. And we can talk about that a little bit more. But just this is the most important part, because this is where they are, is to show you where they've done recently. And it's really over the past year only since the move is there. So keep this in mind. Now, one thing that I want to mention is the so-called Taylor rule a little bit more. It's at the top of the screen. I don't know if you can see it. Mine's a little blurred a little bit by some other thing at the top. But this is the original rule. This is 30 years old. Same old thing. This is from a paper published 30 years ago. And I think it's important because there may be come back to this. As I began my discussion, the Fed was talking a lot about this and they stopped talking about it. Maybe they are beginning to talk about it again. But anyway, little r is the federal funds rate. Little p is the rate of inflation over 4 quarters, is what I used. The target inflation rate is 2%, which was quite unusual at the time. It came from New Zealand. And the equilibrium interest rate is 2. Y is the percentage deviation of real GDP from target. And you can use the unemployment rate. Doesn't make too much difference, but the 0.5 is what I used then. So this is the, I think, a framework. It's not the only framework. It's a framework to look at this, and that's what I want to do. So if you look at this, at the bottom of the chart, the bottom of the page, it shows what happens if, for example, you have a 2% target inflation rate and 2% real, and if you're on target. So target means Y is 0, P is 2. So in this case, it's 2 for the inflation rate, 2 for the equilibrium rate, so 4. So even at the normal, if inflation rate was 2, we should have been 4. Then this is the next line where it says 1 plus 2 is 3. This is taken into account a lot of research. John Williams, now the president of the New York Fed, did a lot of this originally, saying, look, 2 is too high for this equilibrium real rate. Maybe it should be 1. We don't know. So let's assume it's 1. So if you assume it's 1, so that 2 becomes a 1, and you still at equilibrium, you still have 1 plus 2 is 3. So it's still quite higher than 25 basis points even then. Okay, but then you say, well, yeah, that's true, but inflation has started to move. And of course, it's moved a lot. But if it was 3, so 1 plus 3 plus a half times 3 minus 2, so the P is 3, and you assume that the GDP gap is 0, you still got 4.5. So that's where we are now. And so it's good. It's moved up. I think it's the kind of thing that we would like to have happen from our perspective of history and theory. But we're above 3. And so let's stick in 4. Some people say, hey, don't worry, we're at 4. Well, if we stick in 4, you got 1, which is the lower equilibrium rate, plus 4 is the inflation rate, plus a half times 4 minus 2, and just assume Y is 0, since we're seem to be close to full employment, you still get 6. So it's still way above the mid 4s, and that's the sense in which I think the Fed needs to pay attention. Now, this is one rule, this is one thing, but I think it's an important. You should not just completely congratulate. We shouldn't congratulate ourselves on what has happened in the last year, because there's still somewhere to go. So anyway, just to summarize this, if you take the June 17, 2023 monetary policy report, use the Taylor rule that they have in that, and just plug in the inflation rate of the past 4 quarters. Suppose that's 4%. We think it's higher, but it's 4%. Target inflation rate is 2. The equilibrium interest rate is 1. That's not 2 anymore. That's 1. And the gap between GDP and its potential is about 0. You still get a federal funds rate of 6%. And this is just with an inflation rate of 4. It could be higher than that. So this is a sense in which I would argue that the move forward, and this is not a settled matter by the Fed, that's for sure. The move forward should involve some higher rates. And that's based on rules or strategies that we've had around for a while. And they deviated and they're not quite back yet. That's my own view. There's debates about it, whether that's the right rule or not. Now, let me just mention a couple of other things. So this is just plugging in the numbers I just mentioned into that rule. We get 5 or 6%, depending on whether it's 4 or slightly above 4. But so this is a repeat of what's there before. I don't need to elaborate that. But let me mention a few other things. This is, unfortunately, I can't see it again because of the screen. Okay. So this is close to the latest number of the GDP deflator. It's a percent change from a quarter 1 year ago. And you can see this jump. This is smooth to some extent. It's coming down a little bit, but it's still well above 4. It's not as high as it was in the bad old days of the 70s and 80s, and there's more action. The Fed didn't have a 2% target back then, but you can see there's still a danger, and yes, it's coming in the right direction, but it's not there. So this is in some sense what people are worried about. That's what I'm not worried about. I don't want to come back to where we were before. If you like the 3 peaks in the 70s and early 80s, the Fed eased off too much, and it wasn't until they really did it finally back in the early 80s that we got the very better performance of 2% or so more recently. So the danger now is if you let this go or you ease too soon, ease in the sense of bringing the rate down too soon, there's a danger of repeating the same phenomenon. And that's really what I think we want to avoid. The other thing which I want to spend a few minutes on is the rest of the world. This is the ECB, 19 countries. And you can see a nice 2% level there, pretty good policy. But then it has also gone around to 10%. And we don't know exactly how this happened. It could be, there's lots of explanations for these things. It could be people that got too comfortable. But you got to think about this internationally. I don't think there's too much doubt about it. Internationally is a problem. And so how is the ECB going to get back? What is the implication of what's happening in Ukraine? What is the different strategies of Christine Lagarde? What the IMF has a huge role in deciding about this. And so I put this up because it is scary, in my view, because it shows it's not just the United States. And that's not every country, but it's there. And, maybe this number is not as accurate as it might be, but it's there. And it's why this is really, I think, become global. Let me just give you this chart too. This needs to be updated a little bit. This is Latin America, Brazil, Colombia, Chile, Mexico, Peru. They're all up, and they're up around the same time. And the data could be a little better. This does not include Argentina, but the story is there, and some adjustment needs to be made. Now, there's some adjustments being made already, but to what extent and this is really an IMF issue, to what extent is this related to the Fed or to the ECB or other things that are going on? And it seems to me the timing suggests there must be some relationship. It doesn't occur automatically. And I think that's the danger, that's the worry that we have going forward. And so I think whatever happens, this needs to be discussed more broadly. So let me just mention, and then I'll close in a minute or two. Let me just mention, what I'm saying here is not that unusual. This is a picture from last February 2022, a year ago. And it's by Jim Grant, who writes about these things a lot. And he has the federal funds rate there. You can see it's near zero. Federal funds rate implied by non-monetary variables is a year ago, and implied by the Taylor rule. And so it's the same story. This is the biggest deviation you've seen. It rivals what we saw in the late 70s, but it's not as big as we've seen before. And so I think it's important to think of this as not just a so-called Taylor rule. It's different ways to measure this. And the more that we can bring in other measures to test our theories, to test our ideas, the better. But this is, to me, a kind of a striking picture. It's a little out of date. It's February of last year, but you can see that the story is pretty much the same. Even if you raise the federal funds rate to 4%, it's still quite a bit off. And now, finally, let me just say the big question for all of us is, are we entering a new era of high inflation? It seems to me the answer is yes, unless monetary policy makers change, and they've begun to change to some extent. But as you can see, it's the Fed, it's the ECB, it's other countries. There's a new central bank governor coming in Japan, so that might make a difference. Now, at this point, this is maybe particularly disturbing because there's more reasons now for central banks to be guided by rules-based policy. The question is whether this particular episode, where I think it's clear the Fed got behind the curve and maybe led other central banks to do that, we don't know that for sure, but they seem to be off of the rules-based policy. They're getting closer, but they still seem to be on. And the inflation numbers that come in recently are not as reassuring as they might. So the third tick is I outlined a method to do so. I made it simple. Just consider that rule that's 30 years old. And the idea is that central banks should start on these rules now. Markets, they're not new. They're ideas that are around for a while. It doesn't have to be perfect. The exchange rate is not there. Maybe that should be paid more attention to, and especially in Europe. But you can see that there's a real sense in which the message is that central banks should follow rules. And the interest rate, the second subtick there, the policy interest rate would increase if inflation rises. Well, it is rising. It has risen. And so there's still more, I think, to be done. That's my own perspective. Now, let me just mention that these are all contingency plans. If we are fortunate and inflation comes down to 2%, remember 2% is the target for many central banks. It's not all that new. It's been around for a while. But suppose the inflation rate does come down. Suppose it works faster. Then it's possible to make the adjustment. And I think that's why I emphasize these are contingency plans and rules. But if you follow this approach, which I'm advocating, obviously, I think it will reduce the chances of large damage later. And that's what we saw in the 70s. We don't want to ease off and then have to do more, ease off and have to do more. We want to deal with the problem now. And things have changed a lot since the 70s. We've learned a lot globally. We've learned a lot about how the international system works. Not to say things aren't more complicated in other dimensions, but that particular aspect is reassuring. So let me stop there. I hope see if there's any questions, and if not, I can keep talking. But this is my main argument, Nicoletta.
Thank you so much, John. This was exquisite run through. Not just current events, but also how your role and your work and the thinking of many goes into shaping, what might bring inflation into check. I'm going to invite the audience to put questions in the chat as they wish, starting now. And as they do that, I can give them the stage as well, of course, as usual. But as they do that, I would like to start myself with a couple of questions to you, John. to sort of break the ice. So I have, several questions, but the first one is the reason, in part, inflation targets are being set at 2, apart from analysis on what constitutes the optimal inflation target, given enhances in quality and measurement and many other things, is the fact that when expectations surpass a certain threshold, they might become unhinged from the target. And the way inflation targeting, which is now the dominant mode of arranging policy strategies around the world, is to actually have inflation expectation do the lion's share, do the heavy lifting of monetary policy, and interest rates is just signaling a possible path, and by that almost they rein in expectation at lower cost. And your rule does it by having the Apple gap feedback there, or the unemployment feedback. But the question is inflation, in your view, in Europe, where you showed a chart, and we just had data from France and Spain above the 6% mark coming out, is you think of our inflation expectation now unhinged, and is that going to take more than it would have taken? And I guess that's what you're saying here in your last slide. We're going to now have to pay a higher price because we have been complacent. And how much of a price? Is that going to mean a recession in Europe, which is already, basically much there, or in the US? That's I think the main fear, and that's why stock markets are tumbling every time we have worse CPI readings, because they see more interest rate increases and higher likelihood of a bad landing. So that's a question I have, and then I have another more, and then we'll go to the chat.
Okay, thank you very much. This is the most important question: is have we blown it? And I don't think we have. I think things are much different than earlier episodes where inflation picked up. First of all, there is this target. I know there is disputes about whether we need to stick to the target. Maybe it's too low, and we could come back to that, because 2% is lower than a lot of people would like at this point. But I think it'd be a mistake, personally, to give up on that too. It's been a long time occurring. It's been endorsed by many other people. I don't hear too many central banks talking about it, but it's out there. The second part of the question is whether things are different with respect to disinflation. I think they are to some extent. There's more credibility. We're back to 4.5%, and we're talking about it in other countries. And so there's a danger that if it's sudden, if it's unanticipated, it could have a recessionary effect. I think that we've already had a bit of a slowdown early last year, but I don't think that's in the cards. I think if the Fed and other central banks are deliberative or communicative about it, then it should make the adjustment. And that's really what you're indicating, with the indication that inflationary expectations are high, and so just the statement, hey, they're too high, it will automatically bring things down without raising the rate. There are other measures, of course, of monetary tightness, but I think that the notion that they have to do something is clear. And so far, there's other things that policymakers could do. Let's not forget there's regulatory policy, there's international policy more generally, there's fiscal policy. All those things come into play, and we don't want those to go in the other direction. So I think there's more that countries, including the US, could be doing to have higher growth, which would offset some of these things. So while I am very interested in monetary policy, it's not the only thing that we should be concerned about. Anyway, I hope that's helpful.
Absolutely. I think that makes it very clear. We have a bunch of questions in the chat, but I just want to take the opportunity to put one more, which I think is on a lot of people's mind. which is about the inflation target. So in Europe, some policymaker, for example, Isabel Schnabel, last year, she argued that we are facing a new age of energy inflation. So this goes back a little bit to the topic of the war between Russia and Ukraine, but also more generally to the issue of the physical effects of climate change and also the transition to a low carbon economy. And I just wanted to make a reference here to the nice paper by Marco Del Negro and Julian Di Giovanni and Keshav Dogra on, is the green transition inflationary. So basically they say it's really all in price rigidities, right? If you're trying to use taxes moving and, the dirty, we call it the dirty sector, so the non-green sector, so that people are disincentivized from, consuming and demand those goods and move to more sustainable alternatives, that will have an inflationary impact. And as long as we have a transition, that inflation will be there. So it's what I mentioned in the beginning, a shift from inflation causes and from, aggregate demand maybe to a permanent supply shock. And your rule, the 93 paper had, I think the very last piece of the paper has something on when should the Taylor rule not apply. And if I remember correctly, I was trying to dig it. There's a part on supply shocks. There are some cases when you want to be thoughtful of whether, you want a full application of the rule or not. And so, I guess your reaction on, the green transition, the war impact on inflation, and then, this possibility that we might or not have to revise the target. What does your rule say about that? And then I'm going to compile the questions and so that we move on to those. Thanks.
So these are very, very important questions. I think that, the equilibrium real interest rate was moved down from 2 to 1. Maybe some people thought it should be lower. So in some sense, there's already been a bit of a change. And it seemed the questions of green and how the policy should change, I would argue that should be separate. I know it's not implicit separate. There's different types of prices, different types of price rigidities. But I think that it gets very difficult to put those together. And remember that originally 2 was high. 2 is, well, we should have 0. Why didn't you have 0, Taylor? And so I think in some sense that was a bit of a compromise anyway. And by the way, that raises issues. If they do go back to 2, then you can't really, unless you go to negative, which is another issue, you can't go too far below 2. So that becomes into play as well. And then the war, there's always other shocks, to be sure. The exchange rate is probably the one that I worry about most the time, but it disturbs. It's not rocket science. It's hard to do. And so I think these are times where you should pay more attention to the things that and worry about things like war, things that worry about the green economy, but don't have them interfere too much with what we think we know. So anyway, sorry to be a little wishy-washy on that, but I think best is to stick with what we know.
Correct. And we know very little about the price flexibility of some of these green goods too. So it's all quite speculative. But so one question here from Vasily Bazinas is, one of the policy shocks of the pandemic has been large unfunded fiscal shocks that have driven inflation, especially in the US. Do you view that aggressive monetary policy alone is able to curb inflation without a contractionally fiscal shock? And I think you touched upon very fleetingly this before, but fiscal is very important, of course.
Yeah, that's very important. And there's been a lot of fiscal stimulus. The deficit is higher in the US than other countries. This is a real issue. I don't want to take attention away from the monetary side, so I mentioned just briefly. But I think that this is both fiscal and monetary policy. I think the monetary policy is the culprit at this point, since it's since most of the reactions are monetary policy. But I would very much be of a favorable, a more constrained fiscal policy as well. They do go together. There's questions about how you finance the deficit, to what extent that puts pressure on interest rates itself. So I think it'd be better. I wouldn't want to say, don't worry about fiscal policy. And it has been expansionary, maybe too expansionary by people's views. And so, coming back to normal, as I mentioned and alluded to, there's fiscal and monetary policy, and the notion of a fiscal rule is something that's always attracted me. It's, balanced budget. You have a deficit in recessions, you have a surplus in booms. That seems like a good approach, but we're far away from that. And I wish we could get back a little bit towards that. So that's my sense in which the fiscal policy is part of the story. Because I think it feeds back into the money side. It's something we debate a lot in our conferences and things about this. But I would say, let's get the monetary policy right. I think it will work in the sense, if it's announced and clear, it will work without having a contractionary fiscal side. But don't forget the fiscal side. At the same time, we should be adjusting. And this has given me an opportunity to say it's not just monetary, not just fiscal, it's international trade, it's regulation, it's international things as well. So they all go together. And I've emphasized so much, it's not just monetary, it's not just monetary and fiscal, it's the other things as well. So we can't forget about that.
Absolutely. And I think, I guess the coordination can always be better between treasuries and central banks. And we separated them, but at times of large global shocks, that remains very important. But I think especially if you want to have a very generous fiscal policy, you need to intervene fiscally a lot for various reasons. Then, monetary policy has to be set in a way that doesn't unleash, ratcheting inflation. So they work in tandem, but you can also be in a situation where they both lacks, and that's the worst recipe for inflation. And then it's going to be very hard to, as you said, to get rid of inflation, and that's going to be very recessionary. So it's, instead of having a stop-go economy, you can smooth the cycle by working these two policies in a better way. There's a question here about how do you think about non-conventional monetary policy within your framework? So I guess you get that question a lot. So, I think Glenn Ruderbush had something to do some shadow rates, and you can adjust the rule, right? Because you showed that chart of big bulging asset purchases, the Fed at the beginning.
Yes, well, there's lots of alternatives, and there's the fact that money growth it was fast and it slowed down, has attracted a lot of attention. The asset purchases, remember, which is to some extent an alternative way to get longer rates down. And maybe I'm too one-sided, but as I think about these things, the bottom line tends to be the interest rate, which affects the long rate through the term structure. That works pretty well. It's not perfect, of course. There's expectations of what policy will be. And this is something which I should emphasize. When you have a rule or a strategy, it tells you what's going to happen tomorrow and next year as well, right? Because all you have to do is guess what GDP, what the inflation rate will be. As inflation's coming down, you can say, well, the interest rates will come down. And so that's already built in. And I do mention the exchange rate I've worried about a lot. So there's always going to be alternatives, and maybe someone will come up with a really wonderful alternative at some point. But the thing I hear most about these days is adjusting the inflation target from 2 to 3 or whatever, and that I think worries me a lot because it's been there a long time. It's not just the U.S., it's other countries as well. And so giving up on that, we don't know what people will expect. So I think sticking to that, and that's a form of rigidity. I agree, but we should always be looking. That's what monetary scholars do. They're looking for different things to do. That's what the IMF research department does, think about things to do. But it's not, you shouldn't jump there right away. There's something to be said for things that seem to work in retrospect.
Another question we have in the chat is by Javier, is that clearly a key concern of the Fed during the global financial crisis and the pandemic has been the stability of funding markets so that credit could continue to flow. And so the question is, when you talk about, raising rates, is there, clearly this is now, the pandemic is now in the rear mirror, but how should financial stability be incorporated in Fed rules, you think, or should it? At the Bank of England, of course, we started discussing macroprudential at times, house asset price, if you remember, exchange rate, and this is a forever topic, right? This is not going away.
So I think, first of all, distinguishing the two. So funding, dealing with particular problems in markets, long run, short run, you got to be a focus of monetary policy. But I just not lose track of these macro considerations. That seem to me is really what the focus should be. Yet sometimes they interfere. I mentioned the exchange rate several times already. I think that's really where there's pressure and there's pressure. But so funding markets too. Should the lower interest rate be brought in just because it makes financing smoother? I don't think so, but it's possible to think about. I think the main thing right now, but let's celebrate the fact we had nearly 2% inflation for a long time. Let's not celebrate the fact that we're off, and let's try to go back to that. And I think the reasons why we deviated are pretty clear. It's not so much funding. Sometimes people make that argument, but I think it's best to stick with this approach which I mentioned.
Right. Now, one other question by Martin Boluis is, to what extent you view policymakers as ignoring the rule as a construct, as a guide for policy, versus perhaps misjudging the inputs? And I know that the Fed does put some parameters on things, but maybe there are preferences, the FOMC, or people have different takes on these parameters, and that's why, although we have those nice charts, then people take their own position in their head when they're voting. How much you think it's a wrong input problem as opposed to a wrong rule problem?
Well, we don't really know. I know most of the people on the FOMC, and some of them have worked with me in the past, and some haven't. And they all the Fed publishes the rules in their reports. They talk about them. So I think they're certainly aware of them, but there's other issues. Let's not forget politics. Politics becomes part of the issue that they're involved with. So I'd say there's always a pressure to say, hey, this is just a simple little rule. Let's not follow that. It's too simple. We have to take other things into account. Some of the things which have already been mentioned in this discussion. But I think that my sense is we've seen that this has worked pretty well, and we should stick with it as much as possible. There's always going to be political tension. We already mentioned some of them. The fact that the target long run rate is now 1 rather than 0, or 1 rather than 2 is an example. So I think the main thing is to stay as close as possible and not to worry too much about these other explanations. But I'm sorry, it's not the best answer. I talk as much as I can to people without getting in their way. It's not just the United States. Maybe something needs to be said about other countries too. Don't just follow the Fed. If you are, think about other things as well. And I think we'll be better off as a world economy. This is a global issue. Be better off if we do.
It's a global issue, and so it's it's a challenge to really some of the gains in prosperity that also we had achieved, because inflation is a bad in all senses, especially for the most vulnerable.
Yeah.
There's a question, but yeah, so that's bad.
We tend to the costs of inflation are can be very large, and so we tend to forget mentioning that. I didn't mention it too much. Just two is good, but what is bad about five or six? And there's other things that other kinds of policies that come into play which could be more harmful. So we're not in a good situation that way. That's for sure.
And also that's, I guess we should say that that's compounded by the fact that inflation has been stronger in some subcomponents like
Yeah.
food, which of course weighs a lot in lower income classes,
Yeah.
and energy and so forth. There's a question from Torsten Ehlers, who says the 2020 review of the Fed's longer run goals and monetary policy strategy explicitly gave a role for more inclusive unemployment measures. So taking account of the change in the interpretation of the unemployment mandate, do you still believe that monetary policy was tightened too late? And the view expressed by several Fed governors was that in the past, the Fed raised too early with adverse effects on unemployment. And what are your views on this? And I want to add one more thought that I have, which is I was listening to the radio the other day, and people are distinguishing. So employment numbers look good, but employment is of a different quality these days. So when these inputs are measured, we always have the problem of how do you measure them, and is unemployment a good give us a good snapshot of the situation on the ground with how people are doing economically, because people now may have two jobs instead of one, and that's a sign of vulnerability, not a sign of prosperity and well-being in an economic sense. So how do you see this story about the longer run goals of the Fed and the role of unemployment, the dual mandate of the Fed, which goes back, I guess, to your point about
Yeah.
politics?
Yeah, well, the dual mandate is there, and it's important. I mean, one of the reasons to have a
Peut-être
monetary
sur le
policy.
réel aussi, on doit mettre à jour, c'est-à-dire ouais,
Anyway, one of the reasons is we do want to have a smooth growing economy. Recessions are not good; they're very harmful, and so we want to avoid that. So to the extent that you can create a more stable economy with a lower unemployment rate than average, we don't want to have high unemployment. And so I think it's an important goal. It helps remind policymakers that they do want to keep the economy steady. One of the reasons why a steady inflation rate is important, keeps the economy steady, but that's something else they can do again as well. So I would emphasize that. There's been some discussion about the policy in the Fed and what they should be doing. We didn't get into that too much. I sort of stuck with the regular rule type of thing, but I think that will come back and discuss that another time. It's a whole other set of issues about whether the Fed should be changing its strategy or not. The main thing I hear about is don't go too fast and maybe raise the target inflation rate. So I've spoke to those two things.
There's a question here, which I think it's we talked a lot in the decades following the introduction of inflation tax about credibility and how to build credibility. And this question by James Garang says, how do policymakers go about building policy credibility when they keep saying rules are in, rules are out, rules will come in soon, and rules are useful on an on-off basis? I think that's
Yeah. Well, that's a very good question. I don't like how they took them in, and that was not my favorite thing, but they were there before they took them out. And so that occurred a while ago. It wasn't just overnight. And they started to take them out when they deviated. That was really the first episode of taking them out. And I think that's bad. I mean, I think the fact that they're there, the fact that they're in the Fed's report and that there's reference to those, that's very important. It's symbolic, if you like, that they're thinking about that. And so to some extent, this is the environment the Fed operates in. As I mentioned in my opening slide, Jay Powell was criticized by members of Congress for taking it out. And so we don't know all the reasons it would put back in, that's for sure. But I think sticking with something that is there, you could change it a little bit later. There's not just the so-called Taylor rules, other rules as well, that it really helps people understand what monetary policy is about, helps the discussion. But my experience is that it also makes a connect with other people sort of outside the Fed, in the financial markets, in academia, in other countries who are thinking about monetary policy all the time. So this is a way for people to think about it, and there'll be other ways to think about it all the time. But I think this to me, this episode, unfortunately, has reinforced the need for some kind of a rule or a strategy, because they got so far off. You know, you could say 4 percentage points at least, 5 maybe. And so that's a concern. And there has not been much attention paid to that, but I think that scholars and people who look at the Fed should pay more attention to why they were so slow to adjust in the first place.
Right. And I think, the world is changing. Shocks might become bigger, more frequent or not, but the mechanism through which inflation works, still very much hold. And therefore, I think the methods by which central banks bring back inflation, it hasn't changed that much. And so that is an issue. The other issue is the much higher debt legacies that we have now inherited.
Yes.
Just not just 2008, 9, but really the trillions spent to deal with undoing some of these containment measures and their impact on the economy. Someone is, can people put themselves on mute and be careful? Because I have a button here, I can see who is not on mute, but that while I'm talking, I can't do both things at once. I know it happens because it's, some people just by mistake. But, and so, I mean, there's a silver lining of inflation is for the debt legacies to be eroded. Of course, if you look at Greece, just the inflation that they faced recently gave a big shave to, their public debt. So that's kind of good in a sense, but if, of course, that comes at not just at the expense of bondholders or, but also of, the Greek themselves. And this, I'm talking about Greece just to make an example. Of course, this has happened across the board. It's helping shave debt, but this is not the way we should do it. I mean, we shouldn't monetize that. I think it's something that I think macroeconomic frameworks have decided, now decades ago through the so-called divorces, between central banks and treasuries, like in Italy in 1981. So what do you think about the issue of debt and inflation maybe acting conveniently for some policymakers as an erosion mechanism of this huge, liabilities outstanding?
Yeah. Well, I don't think that this is a reason for high inflation for a while, to erode, let's just say, erode the value of the debt, which it does, of course, because there's so many other costs. I think the idea is that we've got this high debt, and we shouldn't not add to it. We should take advantage of times that are good and actually reduce it. Just imagine that. And I think it'd be better off if we do that. Not all countries have made this decision to increase the debt so much. And let me say, you're raising questions which are broader. Globally, we have, as you know very well, Nicoletta, there's lots of countries that are still debating what kind of monetary policy to have. This target inflation rate of 2% became popular, but then it disappeared. So I think that there needs to be more work done, and this includes countries with different systems as well, about how global monetary policy is operating. And I don't want to say that the Fed is the leader, that's for sure. It's not. There's lots of other countries, but remember the ECB, as you know very well, has gathered many countries together to one monetary policy, which sometimes works well, sometimes doesn't work well. But I think maybe that's where we're going down in the future. And I would say, what kind of monetary policy do we want to have 10, 20 years from now? And that's on my mind a lot, quite frankly, because we're not there yet. And we have to get over this particular episode before we can go in that direction.
We also have a question by Vladimir Kliyev on inertia in the rule. So I guess going back to the fact that you said, in your view, the Fed funds rate should be higher. How fast higher should you think the Fed go? And how would you adjust that? Would you just go in one bump, or make it gradual? And also, Vladimir asked, should the Fed continue, in your view, to look at a variety of indicators, including inflation expectations, and pay more or pay more attention to the Taylor rule at the same time? So, do you see it? The Taylor rule could just be the main instrument to provide guidance, then corroborated by other indicators, or they should be all on the same plate.
Yeah, so the speed is very important, and again, people emphasized 4.5 percentage points seems like a lot in one period of time, but it's not so much if you recognize they were behind. So I'd say the more that can be communicated, the better. The people will see, oh, the Fed has gotten behind, they're going to have to make an adjustments. Then they can do that themselves. The idea of a rule or a strategy is it's not just the central bank who's paying attention to it. It's everybody who's paying attention to it. The more the merrier, so to speak. And this gets to the second part of the question about what other things should you be looking at. I think I had M2 up. I had the purchases up as at the beginning of my talk. There has been a lot of focus on that. My view, looking at the asset purchases, is yes, they've affected a longer rate to some extent, but the main thing has been monetary policy, the short end of the curve. And M2 is another question. There's all sorts of focusing on M2, M1. And so what I think is be aware of those things. Certainly don't stop looking at M2 or asset purchases. It's very important. But the main thing, what we've seen is the interest rate, and the inflation rate has begun to come down. We hope it'll come down further. And you do have a lot of models that say that's what you should look at. Interest rate, short rate affects the long rate affects the exchange rate. The system works with lags. There's no question lags are a big part of monetary policy. That's why you have the inflation rate over 4 years rather than over 4 quarters rather than over 1 quarter. That reduces the volatility, if you like. You don't keep adjusting. And I think to some extent, whether you have the unemployment rate or the GDP gap, it doesn't make too much difference. But I would say look at a variety of indicators all the time. It could be M2 comes back as the main. I don't see that right now, but what we've experienced for a long period of time is that the interest rate, the long rate, the exchange rate, the term structure, those are built into how financial markets work. And I think that's what monetary authorities should pay attention to. And there's also just one other thing. I'm very much interested in the international, as you can see, and I think that's maybe some more attention should be paid to that. And what exactly, why is there seem to be a relationship between the decisions in each country? It could be that monetary policy makers are talking a lot to each other. You have G7, you have G20, you have the IMF, et cetera, which is debating these things. So the more that can be explained about the connections internationally, because I do think we're not going to be out of this situation until we have a way to deal with the situation more globally. You know, we have some changes in Japan coming up. We'll have to see how that works out.
What, just to get you right there, you're saying we've been advocating for policy coordination, but I think there can be also bad policy coordination. Like, you know, if there's a delay in one country, there's no reason why others should delay. Is that what your point was here, or I'm reading you?
Well, policy coordination, I mean, one possible policy coordination is each country just follows a Taylor rule or whatever rule they have. It's perfectly fine. Maybe that will work okay, but exchange rate becomes important for many countries. And the exchange rate, of course, the ECB, when countries get together. So I think that's the most important thing globally. I wouldn't say that you need to have particular coordination that the US sees as so Spain should ease or something like that. I think that what's going on in individual countries, China, whatever, are most important at this point. But we haven't settled the international, that's for sure. And the exchange rate is, you know, fixed in Europe, but it's not fixed all over the place. And that has disappeared from a lot of the discussion, but it hasn't gone away forever. So anyway, I think that, to me, the research about international monetary policy is probably the thing that should be focused on the most. And that requires multi-country models. It requires the kind of things that the IMF has done for a long time to get a more substantive aspect of what's going on. And of course, modeling is changing. There's more emphasis on different types of connections between countries. And so that needs to be taken into account as well.
Yes, and I remember the Fed used to, I don't know if they still do now, but they used to have symposia with the ECB, for example, for long, where, models and other views about strategy were exchanged. And those were, of course, are very helpful. Last question from the chat, because we're really reaching the time to come to closure, but I think this is a good one too, by Godfrey Daman. Thanks you for the presentation. And what role, if any, has the use, in your view, the use of unconventional monetary policy characterized by QE or QT played in distorting central bankers' view of rule-based policy formulation? So has that changed, just muddle the waters, thinking straight about, how to go about inflation? And the second point is, would a delayed reversion back to rule-based policy maybe elongate the variable and long lags of a tighter monetary stance if the sequence starts with QT? So I think this is more about how should the mix come. You said at the beginning you don't see the need to do a QT necessarily, but you do see a need for higher rates. So two questions there in one.
Yeah. Well, QE, QT, there'll be a lot more work on those, but it seems to me that have not been as reassuring as the basic funds rate term structure relationship that we have had. I don't disagree that we could continue in a slow, predictable way some QT. The balance sheets are quite larger than they have been before. But the main thing in the medium run, short run, is to get the rate right. And if there's some interference, huge QT, that probably will get in the way. So I would say do a smooth QT and have it in a way that doesn't interfere with policy. Now, the first part of that question was, did it interfere in the first place? And I can't help but think it may have interfered, because it's don't worry about the long rate, we got QE. Don't worry about the short rate because we got QE. And these are huge changes. It's asset purchases and treasury purchases. They're huge changes in the balance sheet. So the fact to say that don't matter, I think is extreme. but they don't matter like regular old monetary policy mattered. And I think that's maybe some more work is necessary to say what was the impact of QE? What is the impact of if there's more QT? And I think that's very important to do. My sense is that they will not be as important as the actual monetary policy decisions, what the Fed and ECB are deciding to do now, as much as they're deliberating that. And I think the main thing is that I would want to leave people with is don't give up. This is working. We're getting inflation down. We got a ways to go to get to 2%. 2% is pretty good, is a nice number to strive for, and don't give up on that.
Thank you so much, John. It was a treat to have you, and we're now just past the 1:15 mark, which is our kind of religious timing for these webinars, but we hope to see you in DC and talk more about these issues. This was very informative. We'll share your slides, and we hope to have you again, and at a time when prices are a little less volatile with us. Thank you so much, and thanks everybody.
Thank you very much.
John.